Good day, everyone. Today is June the 5th, 2025. It is 10:48 a.m. Eastern Standard Time. Wanted to do a follow-up video entry on risk profiles. So we said we were going to answer some questions about risk profiles. Okay, so here we have the SPX. Boy, we just are barely up for the year. Just barely, I think. Yeah, what is it, that 58.63 or so is where we began the year, depending on how you count it from the 31st or from the open on January. But regardless, we are up just a little bit on the SPOOs itself. However, we are having a much better time in the equity fixed income hybrid core model that we have been demonstrating. So first of all, our drawdowns were not severe when just looking at the positions themselves, right? So what you're looking at is a conglomeration of all of those positions, including the three we have yet to pick up. But we've been doing better than this, right? So we are definitely up on the year. Plus we've had all the dividends come in. Plus we've had a little bit of yield that's not discount to yield that's not really showing up here. So we have actually been doing a little bit better, okay? So we talked about in this entry over here we are. Dynamically targeting differing risk profiles. How exactly? And the link to this entry right here is dynamically targeting different convex return profiles, a GTC Traders sort of mini course, right? And so we talked about evaluating risk profiles, introduced ones to a bunch of concepts, style drifting, scope creep, volatility. It was like a volatility of returns 101 little bit, risk profiles, examining performance databases, gave you a link to a performance database, and then our own switch, right, as far as dynamically switching between different risk profiles in the same portfolio. So the question comes about, that's all well and good, sounds fantastic, but how do you do that? Like, how do you decide that, yeah, I want a linear profile now? And just, what, do you just snap your fingers and twist your nose a little bit and it becomes so? Wow, only an old guy like me is going to get that reference. But, how exactly do you go about targeting differing risk profiles? Well, let's go back here to the equity fixed income hybrid core. That's been doing very well. We're very well pleased with the performance. Actually, we've been doing a little bit better than this, right? Because of the way we make our purchases. And I don't mean the position sizing. I mean just when it's time, right? We just bought we've bought two. It's not, here's the thing, man. You come on board with the equity income fixed income hybrid core, and it's showing how the objective is income and how to build something up from almost nothing. You could start with $0. Everything's a percentage, right? Just save the capital and then look at the percentages of what's done and then do according to those percentages, right? But it's very low effort. I am big on low effort, let me tell you. I'm really big on low effort. So it's very low effort, but when there's something to do, you have to do it, right? And when we make those purchases, we made a purchase of a new asset in February, and we made a purchase of a new asset last month in May. And so actually the performance is a little bit better because of the advantage we build when we're buying those assets. Okay, and if you go back to the other entry over here, that's sort of a look ahead and sort of our thoughts as we begin June. We usually put that out sometime in the first week. If you go to the equity, let me see, there's total portfolio right here. Could one simply buy all 18 pieces simultaneously if they have the cash to do so, given this part of the portfolio is for income? Yes, but we cover the nuances of that question in this entry at this link. You click on that link, it'll take you to a whole video entry on that very topic. We just put that out there as a reminder. You can review that because of those advantages we build in, because we're very, very patient as to when we make our purchases. Then that builds some of our advantage. And when you build some of your advantage, and remember, we're just talking about the equity income hybrid core now. When you build that sort of advantage, it makes things a little more linear. It does. right? It's very, very slight. But when you are just patient and patient and patient and patient and patient, and there's my shot, I'm going to take it. Then, you know, for buying the asset we bought back in February and then buying as we did last month, right? That builds a little more linearity. But what really builds the linearity of this program as of late, rather than absolute returns, but linear returns, which is what we're targeting, it really has to do with the equity fixed income hybrid core anyways, at least with this entry. Picture perfect buy-ins, outcomes are unpredictable. Picture perfect buy-ins, outcomes are unpredictable. You know, you look at Costco. And it's like the trap, the deception is, oh my goodness, look where you bought in. And that one's up on the GTC Traders main site when we did that, right? Oh my goodness, that perfect buy-in. The trap is looking at that image and seeing it rally and thinking that's what made the entry good. No, what made the entry good is we followed the process. What happened afterwards, that's beside the point. We're not buying this for a chart. Oh, this one doesn't pay as high a dividend. Who gives a rat's behind? Right? I mean, some of them we have in there for high dividend. I looked at the yield on cost for some of them. It's up around 11%, 12%, something like that. The yield on cost, some of these assets. Trust you me when I say this. This particular basket is built on a very quantitative strategy architecture with a lot of thought behind it. And even how, if we had to replace a piece, how we would go about doing that. There is a lot of thought behind it. So something like Costco doesn't have the highest yield. Oh, I don't like going for Costco. That doesn't have the highest yield. And you take that one piece out. Well, what did we talk about besides that, right? There's so many concepts that go into the construction of this equity income hybrid core. It's crazy. So I don't want to get lost inside my own head. First of all, just keeping it back, just rewinding a few seconds here, Dan, to what we said at the beginning. We keep to the process, right? So we keep to the process and we're patient. That will help, to the theme that we're talking about here, build some linearity. But what really builds the linearity is because of our overall thesis on macro at the moment, right? For all of the reasons that you know. Think about it. We couldn't predict it rallied. And we actually, as of the end of May, I believe, have alpha over the market, which I have to say this again. For an equity income hybrid core, something built for income, you generally don't find that. And it's not the purpose, it's not the objective, it's just an interesting side piece. But you don't usually find one that's beating the S&P 500 index. As I said, there is a lot of thought that went into something that looks very simple, right? You remember that one entry? Where that entry where we're talking about targeting different return profiles? It looks simple. You see somebody rolling that's a black belt, and it looks, oh, I could do that. Okay, well, let's see you try, right? It looks deceptively simple. There is a lot of thought behind this, which is why, and that's not even the point. It's not the objective. This has just been a happy byproduct, but the equity income hybrid core has alpha over the market when that's not even the point of the thing. And even doing that, we're beating the market, right? So, which I couldn't be more pleased with the performance of the equity income hybrid core. Plus, there's, as you know, key moments when we hedge off, how you hedge off, how much you hedge off, right, during key critical junctures. Oh, and here's another thing. This goes into the construction. Remember how I said there's a lot of thought that went behind it? Have you noticed? We build that linearity of returns, okay, and that's why you've seen that. Now let's move to the long-short valuation investing account. So we're going to look at that image. So as you know, this particular account has only been interested in short positions because of our macro thesis, which I would like you to find a fund out there that is short only, and doing as well as we're doing, right? So you might look at this and think, well, yeah, the strategy is going to build that linearity because you showed us what the strategy is. And there's links on when we talk about that. If you don't have it, like, send me a DM on Twitter or something. That's usually the best way to get a hold of me. Or do a search. You should find it, for the neutral carry strategy short strategy we're using here. It's a type of barbell or sometimes they're called dumbbell or barbell strategies. But like, you can name it a bunch of different things. But regardless, you look at the strategy and say, well, yeah, that's what's building the linearity. And yeah, it's very impressive performance for something in this market that only seems to want to go up. It's very impressive performance if it's short only, right? But we know what the strategy is, so okay, we understand how you're doing that. All right, but there's a little nuance here, and are you catching that nuance? We've always said we're only showing you a look over our shoulder as to how we do this. We could run more absolute programs, and people love those, right? And they would be up, right? Mandates that I work under are very concerned with linearity of returns. They don't mind absolute returns because I've already shown you the dynamic regime switch, right? So we'll go for absolutes. It's a whole thought process, folks. My point is, if you